Hello class, this is Dr. Fenton. I'm working another homework problem in Module 5, so let's take a look at this one. We have a corporation and it expects to begin operations January 1st. It will operate a specialty sales company that sells laser pointers over the internet. They expect sales in January, year 1, to total $220,000 and to increase 10% per month in February and March. All sales are on account. Now, pay attention to this sentence right here. It says Rooney expects to collect 67% of accounts receivable in the month of sale, 21% in the month following the sale, 12% in the second month following the sale. Well, what does this mean? Well, for example, it is saying that of the $220,000 in sales on account in January, they expect to collect cash on 67% of those in January, the month of sale. They expect to collect 21% of the January sales in cash in February, the month following the sale. And then 12% of January sales will be collected in cash in March. So when you make some sales in January, they will be collected over a 3-month period. 67% in January, 21% in February, 12% in March. The same collection pattern happens for every month's sales. And that's the same thing for February and March. In February, you'll collect the cash from those sales in February, March, and April. In March, you'll collect those sales in March, April, and May. So the first part here, A, is very, very easy. Prepare a sales budget for the first quarter of year 1. First quarter will be, of course, three months. We take the expected $220,000 in sales, and that, of course, is January sales. February is the increase you expect, and so they expect to increase sales 10% per month, going in February and going into March. The only thing you do is take January sales of $220,000 times 1.1, and that'll give you a 10% increase. That's a 10% increase. $220,000 times 1.1 gives you $242,000. Do the same thing for March's computations. Take February's sales we have here, $242,000 times 1.1, 10% more. That gets you the $266,200. So quite easy. Start with what they give you, add 10%, and then add 10% more, January, February, March. For B, the only thing you're doing for B is just adding in the sales you had for Part A. Add this, this, and this. And that's all it is. Those three numbers are added, and there's your answer for Part B. Now, Part C says, prepare a cash receipt schedule for the first quarter of year 1. Okay, we're going to take a little bit past the first quarter just to show you when it's all going to be collected. But we really only need it for these 3 months. But I want to show you how March and part of February kicks over into April and May. So in Part C, let's just look at the answer. Here's the answer, but here are the computations. Let's look at both of these together. Now, to show what's collected in January, this number, they're all the same right through here. What you're going to do is take January's sales, and that's at $220,000. I'll go back right here, this 220, and that'll be times, let's go back up to this number, times 67%. So we got 67% collected in the month of sale, 21% in the month after, and 12% in the second month following the sale. So 67, 21, and 12. So let's go back to C. A little more, there we go. So $220,000 times 67%, 0.67, gives you $147,400. So this is the company's first month of operations. They had sales of $220,000. That's the expected sales. So they expect in January to collect 67% of January's sales in cash. That's all that's coming in January, just part of January's sales. Now in February, we have two types of cash collections going on in February. We have another 21%. Again, don't forget about these numbers up here. 21% month after, 12%, we're going to use this in a second also, second month after the sale. So if we take $220,000 times 21%, 0.21, we'll get $46,200. So we drop that in here, 46,200. Now what we're going to do is look for receipts, is cash receipts in February sales. And so February sales are $242,000. Let's take that times 67%. Remember, when we have sales in a month, we're going to collect 67% of those sales in that month. So February sales, we're going to collect in cash 67% of this number, which is $162,140. That's all you're going to collect in February. You're collecting part of January sales and part of February sales in February. Let's go to March. March, we're collecting three different types. We're collecting the remaining part of January sales. We are collecting part of February's and part of March's sales. So what we're going to do, let's finish up collecting January sales. So let's take $220,000, going back to January sales, times the 12%. I'll go back up and show you. Times this 12%. So 220 times 0.12 gives you $26,400. And there you see we have January sales, collected, most of it in January, but part of it in February and a little bit more in March. And there we've collected all of January sales in cash. We also in March are going to collect part of February sales. So we take February sales, 242 times 21%, 0.21. So $242,000 times 0.21 gives us $50,820 of cash we're collecting in March for February sales. I should say from February sales. We're in March, so we are going to collect 67% of March's sales. So take March's sales, 266.2 times 0.67, that gives us $178,354. So in March, we're collecting these three items from January sales, March sales, and from February sales and from March sales. You can see the little plus minus here. That means you could be off due to a rounding error, so giving us some leeway here on the answer. Now, this is the first quarter. Let's go ahead and see how much we're going to collect in April and May. In April, we're going to collect the remaining part of February sales. And we're going to ignore April and May's sales. We're not worried about that now. But in April, we're going to collect the remaining part of February sales and then part of March's sales. So this is 21%, this is 12% of February sales. This is 21% of March's sales will be collected in April. When you get to May, how much of this over here will be collected in May? Only the remaining of March's sales. 2 months after March, we're going to collect 12%. So 12% times 266.2 gives us $31,944. So this shows you, of those 3 months of sales, January, February, March, when will you collect the cash? Most of it in the month of sale, here, here, and here. But then you're going to collect part of it, of January sales in February, part of January sales in March, and you have the same pattern all the way through. Okay, so that's how we get these numbers for requirement C. This is the expected cash collection in these months for the sales in January, February, and March. Now requirement D says, determine the accounts receivable as of March 31st, year 1. Okay, let's go down to here so we can see all this. Here is the answer right here. So where did this come from? These two numbers here. So at the end of March, we have an accounts receivable, part of February sales, part of March's sales, and then another part of March's sales that will be collected in May. All this will be in accounts receivable as of the end of March from the first quarter sales. February, March, really. Okay, that's what they're showing here. The 84,942 there, plus 31,944 right here. There's the 116,866. So again, as of March 31st, how much do customers still owe us in cash? It's the part of these sales we're going to collect in April and May. That's the March 31st account receivable. Okay, so that's it for this problem, and hopefully that helped you.